Good morning. Traderfirstyear with an additional new trade idea for 2/22/2021. I haven't posted one in a while, so this will be the first one. So it's a new options position. Strangles, puts and calls. Traders will be long theta and short gamma profile to take advantage of a fall in implied and realized volatility. Expected outperformance from 2/22 to 3/05/2021. And traders will be taking advantage again of the fall in realized and implied volatility and overall market dispersion. The TLDR, if you want to avoid the small print, condensed version of the trade is pretty straightforward. It is short vol via short front dated options and a short gamma profile. End goal is to make potentially $500 in a few weeks. Disclaimer, you're going to have exposure of $205,000 for those 2 weeks. Just to make the $500. Volatility expectations. Markets are implying a move of 1.54% plus or minus up down on the S&P 500. Markets have realized a move of 0.93 plus minus up down on the S&P 500. The difference between what market makers are implying and what has been realized has widened. The spread increased to 10 basis points. The VIX is expected to move 7.38%. The VIX is currently at 24.49. The VIX price range is 26.29 to 22.80. The market is currently pricing in a weekly move in the S&P 500 of 1.6%. That's up or down. So we could be seeing a high on the SPY at 396.26 and a low at 383.87. The market is currently pricing in a weekly move in the Nasdaq of 2.2% up or down, and that could indicate that the QQQs could trade as high as 338.32 and as low as 323.91. The market is currently pricing in a weekly move on the Dow Jones Industrial average of 1.67% up or down, and so on the DIA ticker, that could be a high of 319.91 or a low as 309.49. The full summary and rationale for the trade. Realized and implied volatility are currently moving in opposite directions. Implied volatility on major indices continues to rise, while realized volatility slightly declines. The rise in implied volatility is favorable for convexity sellers engaging in 5% out of the money strangles on the S&P or SPY, QQQ, and DIA tickers. The duration of the trade is for 2 weeks, starting on the 22nd, which is today, and expiring on the 5th, which is the first Friday in March. The risk for the trade is any large increase in realized volatility which causes equity markets to move up or down greater than 5% to 7% over the 2-week period. This would create substantial problems to the right and left side of the distribution curve. What we would like to happen is the movement of less than 4% and greater than -4% for the full duration of this trade on each of the indices. Since they're all priced 5% out of the money to the upside and then 5% out of the money to the downside is what you're writing on these. And these are call rights and put rights. So on the SPY, the initial underlying price was 387.67. You multiply that by 5%, you get a strike that's going to be 407, and then if you divide that, you're going to get a 5% out of the money put price out of a 369, and you can see the prices on each of these as you go through these. So when you go left to right, ticker, expiration date, strike, underlying price, options, put, call, the income that you're going to take in, because again you're selling convexity into the market, so you're going to be taking in income. It's going to be about a little bit under 500, but we're going to round up to 500. The amount of exposure on one share obviously is going to be fairly large for each of these, and so the total amount of exposure just to collect the 205 is about $205,000 on 500 just to collect $500, and the break evens are also included to the right. And so thanks for following, and expect more trades and videos to come.